Hi, everybody. This is from my online Accounting 203 course. Um, I wanted to highlight an important topic that we covered this week. So we are in chapter 21, cost, volume, profit analysis. And in this chapter, we learn about different costs. So we talk about variable costs, which are things like direct labor, direct materials, items that are directly associated with the cost to produce a good or to provide a service that we're going to get paid for, right? Then we talk about fixed costs, and fixed costs are costs that are fixed and that don't change as the activity base changes. So variable costs, at least for total variable cost, there'll be an increase as the as the activity base increases, which could be things like production, service hours, things like that. Whereas fixed costs stay the same regardless if there's a change in the activity base. So there's a whole section on variable fixed costs. Please make sure you look at that. I did want to highlight that once we understand variable and fixed costs, how we can use these to calculate a contribution margin, and then what we can do with that. So the definition of contribution margin is, excuse me, on the wrong one, is sales minus variable costs. So sales minus the cost associated with those sales. So direct labor, direct materials. That is going to be your contribution margin. It's the profit that you get just from the sale of the goods or service after you subtract the direct costs from that good or service. And then what you would do is you would use that contribution margin to pay down your fixed cost, right? So that would be contribution margin. And the contribution margin would be used to pay things like rent and other fixed costs that aren't directly associated with sales. So contribution margin is important in our study this week. And here's an example of a contribution margin income statement. So here we have 50,000 units, and we sell them at a selling price of $20 per unit. So our sales are $1 million. Our variable costs are the same 50,000 units because the activity base would be the units sold multiplied by $12 per unit. That's the variable cost per unit. When you look at variable cost, you'll see that variable cost per unit on a unit basis does not change. It's going to remain whatever that per unit variable cost is. It's a flat line. Whereas the variable cost in total is an increasing line as the activity base increases. So here we take the 50,000 units, multiply it by the $12 per unit, and we get a $600,000 total variable cost. So our contribution margin is $400,000. Our fixed costs are $300,000. So when you take that contribution margin of $400,000, subtract it from your fixed obligation, your fixed cost, you're left with an income of $100,000. So that is the contribution margin. The other way that you can look at that is on a per unit basis. And you could say in relation to contribution margin, and you could say that the selling price per unit is $20. The sales price is, the sales price is $20 per unit. That's the selling price. The variable cost per unit is $12 per unit. Which would give you a contribution margin of $8 per unit. And what that means is for every sale, you receive $8 to apply to your fixed cost. I'm going to skip the contribution margin ratio for a minute, but I want to apply this contribution margin to break even. So a term that we learned about this week is break even. And break even is how many units do I need to sell in order to cover my fixed costs. And the formula to figure out the break-even sales in units, how many units do I need to sell to cover my fixed cost, is total fixed cost divided by the unit contribution margin. And the formula for unit contribution margin is selling price minus variable cost. So that would be in the previous example. If we can get there. There we go. In the previous example, it would be the $20 selling price minus the contribution margin per unit would be that $20 selling price minus the $12 per unit to get to an $8 contribution margin per unit. So the break even in units sold, how many units do I need to sell in order to break even, would be fixed cost, total fixed cost divided by the unit contribution margin, which is selling price minus variable cost. And then here we have an example. So we have a company, Baker Corporation, that has $90,000 in fixed cost. The selling price is $25 per unit. The variable cost per unit is $15. The unit contribution margin is $10 per unit. So with the $90,000 fixed cost and the $10 unit contribution margin, we can then calculate the break-even sales in units sold. How many units do I have to sell to cover that $90,000 fixed cost, where my profit would be zero, but I paid for all these fixed costs? The formula would be $90,000 divided by $10, which would be 9,000 units. So that's how we calculate break even on a unit basis. Another way to look at contribution margin is to look at contribution margin as a percentage of sales. So contribution margin as a percentage of sales. And the formula would be contribution margin divided by sales. So in this previous example here, sales are 100,000, contribution margin is 400,000. So when we calculate contribution margin divided by sales, we get $400,000 of contribution margin divided by $1 million of sales, and that equals 40%. So for each dollar that we sell, we get 40 cents as profit that we can apply to our fixed cost. You can also do the same calculation on a unit basis, looking at the unit contribution margin of $8 divided by the selling price of 20, you would get the same 40%. So every dollar of sales equals 40 cents of profit. Why that's important is because on break even, we can also calculate break even in dollars. So to calculate break even in dollars, you take fixed cost, right? Fixed cost, and you divide it by the unit contribution margin ratio. Like we said before, that would be the unit contribution margin divided by the selling price. It's that 40% that we talked about earlier. So it's the fixed cost divided by the contribution margin ratio. When you take that fixed cost in the numerator and divide it by the percentage contribution margin ratio in the denominator, you'll get the break-even sales in dollars. So that will tell you how many dollars do I need to sell. So how many sales in total dollars do I need to sell in order to break even? Here we have the same 40% based on the previous example with the 90,000 fixed cost, $25 selling price, and $15 variable cost, $10 unit contribution margin. So with that example, we would take our fixed cost of 900,000 divided by the 40% contribution margin. We get that by taking the unit contribution margin of $10 divided by the selling price. When we do that, we say, okay, we need to sell $225,000 worth of goods. So instead of focusing on units, we do it on total sales at 40% contribution margin. We need to cover $225,000 in total sales revenue. And then the last thing I want to talk about is target profit. Target profit is similar. It's the same exact calculation as break even in both quantity and sales. But instead of solving for zero, break even is to get us to a gross profit of zero. Instead of solving for zero, we're going to solve for a target profit. So in this example, we're going to take, in the calculation, what we do is, if we're solving in units, how many units do we need to produce or sell in order to come up with a target profit? The formula would be fixed cost in the numerator plus whatever the desired target profit would be divided by the unit contribution margin. So just like break even in units, but we're going to add target profit to the numerator, and that will tell you how much units I need to sell to get to that target profit. So here we have fixed cost of 200,000, a target profit of 100,000, a contribution margin of 30. Break even would be $200,000 fixed cost divided by 30. But instead of break even, we want to solve for a target profit we want to make $100,000. So the change would be fixed cost plus the target profit in the numerator divided by the unit contribution margin in the denominator. So we would need to sell 10,000 units in order to make our target profit of $100,000. So that's it for the video this week. Break even and contribution margin are key to the chapter. Let me know if you have any questions. I'd be happy to help. If you don't have questions, and if I don't hear from you, then I will talk to you next week. Thank you, everybody, and I will talk to you soon.